and welcome to the presentation about what drives Forex markets, the technical side of it. Before we start, let's take a look at what we will be going through in the next few minutes and what you will be getting as learning outcomes. First of all, what are the FX markets, its structure, its size, its advantages? What is technical analysis, the essence of graphs, and what information they include? What is support and resistance, a key feature for novice traders? What are charts and the abundance of information they provide? Also, what are indicators and oscillators, how they can help you achieve your goal? With so many market participants involved in foreign exchange trading, we first need to take a look at what makes FX so interesting and appealing. With so much money, an estimated of over 4 to 5 trillion US dollars traded every single day in the FX markets, there are many ways in which traders make their buy and sell calls. With around 80% of all trade calls being attributed to technical analysis, knowing your technicals is essential when getting the edge trading Forex. It should be noted that currencies are traded in pairs, for example the dollar against the yen or the euro against the dollar. When you buy a currency, you're simultaneously selling its pair. You never just buy or sell a single currency. You're executing just one trade though, but the mechanics involve the simultaneous opposite position in the other currency. If, for instance, you are buying the euro dollar, it means that you are buying the euro and selling the dollar at the same time. The demand for FX pairs is affecting many technical trading aspects. Being a highly liquid market and with the flexibility of 24-hour trading, but also easiness of going long or short, and with the ample use of leverage, it is very much intertwined with technical decisions. All traders use charts and technical analysis. This is something indispensable, as you will find that many major or minor moves can be depicted on a single piece of information, the chart. As per above, it does not explain 100% of your strategy, but it does account for the majority of your trading decisions. The term that has been coined to denote that your decisions are made up of both technical and fundamental analysis, as it is called, is fusion analysis. There are tons of ink being shed in praising the merits of technical analysis. We will try to stick to the basics so you can understand its importance. Once you master those, you will find useful to be on a continuous learning curve. There is a multitude of information regarding technical analysis. Technical analysis revolves around the data that the market provides. Market highs, lows, opens and closes. Once this information is recorded, it is set in stone. It is there for everyone to see. This means that we all have access to the same information. How we interpret this, however, may be different. The important thing to remember with charting, support and resistance, trends and indicators is the self-fulfilling prophecy. If the majority of traders use them in the same way, then the markets are likely to respond. All trading softwares will give you access to the same trading tools. Type of charts, candlesticks, bar charts, pointed figure, indicators, oscillators, as well as the tools to identify major support and resistance lines or accumulation and distribution areas. You might already be familiar with the notions of head and shoulders formation, triple bottom, rising wedge, relative strength index, moving average, Bollinger Bands, and the list goes on. All these are among the tools that you can either draft or use, which help you make your trading calls. But not just you, everyone. You will find that one of the main problems traders face with technical analysis is trying to reinvent it. They try to find technical analysis combinations that other people may not have thought of. If you do this, then you will be the only one trading with this information, and the powerful self-fulfilling prophecy of technical trading does not follow. With a vast choice of financial portals and dedicated websites, we have instant access to generic but also more detailed information. For example, when you see charts on the news channels, you generally see the line charts from the Bloomberg terminals. These are great for illustration in price movement. A simple, clean chart which shows the direction of an underlying, that is, an asset. They are, however, not designed for the retail trader, such as yourself, to use for their charting and technical analysis. There is a multitude of software packages which you can use to gain access to the information that you can use, designed for retail traders. You might also find that the majority of the tools you need are included in the trading platform that you are using. For short-term and intraday traders, charts are an essential tool when interpreting data. The format in which you view the data is also very important. The most accepted form of viewing technical data is by using candlesticks. A way to depict in a clear visual way all necessary information is just one candle, as we will now see. What are the candlesticks then? Candlesticks have been around since the 18th century. Steve Nielsen popularized the use of candlesticks in technical trading in his book Japanese Candlestick Charting Techniques, an essential manual for starters. You might find they come with funny names in an effort to describe a bullish or bearish situation, such as hanging man, abandoned baby, harami, doji, etc., but they are very handy. His view was that people could use the Japanese candlestick methodology to interpret data in a more understandable way and use individual candlesticks and clusters of candlesticks for their own trading strategies. The way that a single candle shows all the vital information with a different color to denote a negative, bearish, red candle or a positive, bullish, green candle has earned them the popularity they deserve. You can see at the graph to the right an example of what a candlestick chart looks like. Candlesticks are widely regarded as the most reliable way of interpreting technical data because each candlestick has 5 pieces of information. What are these? First, the high, as shown on the example by the extended black line at the top. Second, the low, as shown on the example by the extended black line at the bottom. Third, the open, being the lower point of the candle per se. And 4, the close, being the upper point of the candle per se. And 5, whether this is a selling or buying candle. A green candle will denote buying forces, whereas a red candle will denote selling forces. The easiness of this visual information makes each candlestick on their own very powerful for determining market direction, as discussed. Also, when candlesticks are used in clusters or formations, they again give more information as to the potential direction of a market. There could be a whole topic alone on candlesticks, as there is a wealth of information and endless ways to interpret them. The basic principles are that individual candles can help determine certain long-term signals, such as the hammer, which at the bottom of a range or a selling move could signal that buyers will enter the market. You can see what a hammer looks like with a short body and a long tail in the example to the left. Then there are clusters of candle formations thought to be stronger signals, as there are more candles to take into account. These allow traders to spot key reversals or continuation patterns in the current trend. These can then be used for short, medium, or long-term trade ideas. In this example, we see the island formation. This is 2 gaps, both to the upside of the trend. These can illustrate the gaps around the island all being bullish to the upside, that buyers will remain to push this market up. A gap is where the price of the next candle is higher than the one before that without any other that has taken place in between. So essentially a jump from a previous candle. You can clearly see marked the 2 gaps we have identified in this example. Gaps could take various forms, and their analysis could also be beneficial to your trading calls. But let's stick to candles for now. Candlesticks are great for displaying information, as you can tell for yourself. They should, however, be used with a combination of other indicators and oscillators. The key to trading technically is having a balance of information. No one information will give you everything you need to know to make sound trading decisions. You need an array of indicators, oscillators, as well as take into account an important factor, that of psychology. We'll talk about this in more detail in another presentation, but for now, you should keep in mind that it is a vital part of our success, as we're human beings after all, and are supposed to make rational decisions, but we are not. Here is a basic but all the more important notion of technicals, the support and resistance lines. With support and resistance, it is always better to start with the basics. Line of sight is a good way to spot potential support and resistance. This is the process of matching up highs and lows and opens and closes on the candles. If 2 or more points line up, This can be considered support or resistance. Take, for example, the areas marked in light blue frame in the chart provided. You can see that even in the short-term horizon, you can spot several candles clustering around the same area, which will denote either base or topping signals. When a certain level at the bottom is retested, it means that buyers are willing to stake their money in this underline every time it has touched that price. The price then, we say, that it finds a support at that level. The same with resistance. Every time a price hits a certain high level, sellers are willing to offload so that this becomes a tough point to overcome. When used in combination with the other technical tools available, support and resistance lines can give you a powerful message in all time frames. Understand that the art of trading is to spot what is obvious to other traders. This, in essence, is the self-fulfilling prophecy of technical analysis in action. If it looks like it should be support, then it probably will be. Think of support and resistance levels as break or bounce areas as above. Or alternatively, don't categorize them as support or resistance, but as points of interest. This way, you can buy into strength and sell into weakness. In the same example, you can see that the areas we marked served as a good indicator of market direction. With red arrows at the beginning of the movement, you can see that the market bounced from its lower levels of support or increased buying interest and scored higher prices. It then went back and retested the lower prices and yet again bounced upwards until it made a new high and an important break marked in red, which took it to even higher levels. This is a strong signal to be aware of. This gives you an idea of where there have been more buyers than sellers in the case of support and vice versa. Every market will go up and also go down. The art of being a good technical trader is not getting married to an opinion. You should be happy to both buy and sell. The longer-term trend is for investors, not traders. As intraday traders, you only want to capitalize on movement, not the overall direction. Now, let's take a look at what the trend is. The trend is your friend is a popular term used in trading. This is true, but as with everything related to trading, timing is key. When you trade in the very short term, the overall trend is important, but you can make money buying and selling all around the trend, as in this example. You can see more red candles than green, and also what we would say are successive lower highs and lower lows. Although one can easily visualize the overall trend, you can also spot various instances which represent an opportunity against the trend, as we call it. This might very well be true in the short term, as in intraday trading, but also in the longer term. A key point to mention, not all trends are perfect. You can get false breakouts. Nothing in technical analysis is perfect. See the breakout we've drawn here. The trend remained intact for quite a while with falling prices. However, there reached a point where what was acting as a resistance area has now been broken, and prices have started to form higher levels with new candles outside the lines. This might be a temporary breakout where prices revert back to that falling channel, or might well be a start of a new trend, this time on the upside. It is just how markets work. Traders often think they can only make money buying strength or selling weakness. This is a good rule of thumb, but it is important to know, as with support and resistance, that markets trend and also break out. You can clearly see that this is a downtrend. However, you can buy the break and still make money in the short term. We now examine the different time frames. You can plot your charts by using data on a weekly basis, a monthly basis, an hourly basis, or even a tick basis. If you want to trade with a trend, then history is your best point of reference. What happened in the past is a good indicator of what can happen in the future. But do please use that as an indicator and not as a certainty. Markets don't exactly repeat themselves, but they certainly do rhyme. If we take the cable, for example, the British pound versus the US dollar, then we can clearly see what happened in the larger time frame, the weekly for instance, and how this follows through to the smaller time frame, daily and hourly. If we are selling on the weekly and daily time frames, what is the logical outcome on the hourly? The trend continues and the sterling moves lower. However, you might also find that in the larger time frames, that is the weekly one in our example, a trend is down, but that in the smaller ones, due to market volatility or short-term news or indeed market noise, the trend is really upwards. The big picture is always a good indicator, but knowing which time frame you are trading requires attention to what short-term positions you will be opening. The euro-dollar, for example, could be heading upwards given Eurozone's financial robustness, but that in the next day or two there are significant pressures on the euro due to an important figure announcement such as jobless claims. Once you master the idea of operating on a multiple time frame logic and are able to spot support and resistance areas, you will then find it useful to add to your analysis what we call indicators and oscillators. It is important to know that indicators and oscillators are part of the same technical analysis family. The indicators appear on the actual candles, such as Bollinger Bands that we have drawn in this example, but you can see the bands narrowing and opening along the different candle formations on the same chart. This is a popular indicator that we are analyzing in a separate video. Indicators can also act as an alert for price action or breakouts. Oscillators, on the other hand, are indicators too. They just work to a scale, 0 to 1 or 1 to 100, depending on the oscillator type. They usually appear outside of the chart, such as in this example. You might have come across with the term stochastic oscillator, for example, ranking among the most popular ones. Bollinger Bands, as per above, are a great example of visual indicators. They appear around candlesticks and show potential levels of support or resistance. They can also be seen as displaying areas where the markets are overbought and oversold by denoting signs of exhaustion or bursting of volatility. Remember the self-fulfilling nature of technical analysis. The majority of the market traders will look at Bollinger Bands. This is because they're based on the moving average. Most traders will use technical trading. See how the Bollinger Bands would have helped you with your short-term trading decision in this example. Marked with the light blue frames are the lower and higher points that you could have taken advantage of. Oscillators also show areas of support and resistance or overbought or oversold territories. These, however, use a scale. In this instance, the RSI, the Relative Strength Index, shows this by standard levels. 70 is overbought and 30 is oversold. 20, 80 are the extremes of these limits, as the RSI very rarely gets as high as 100 or as low as 0. You can see that it rises with the rising candles, but also shows that from the higher levels there has been a falling pattern. One of the common mistakes is that overcomplication of technical analysis. The temptation when using technical analysis is to use everything. This is never a good idea. If you use too many forms of technical analysis, you will get conflicting signals. Keep it simple. Use 3 or 4 combinations of indicators and oscillators. Maybe try Fibonacci, the Relative Strength Index, Bollinger Bands. We are examining those in more detail in separate presentations. Once you have studied and worked with the majority of these indicators and oscillators, you will be able to discard what you feel is a noise to your own trading system and keep only what really helps you. In some cases, this might just be the price action, or a simple indicator such as the moving average and maybe 2 time frames. It really depends on what style will suit you. But in essence, human tendency will be that of overcomplicating, of the willingness to use everything you know. Don't waste your time in finding the Holy Grail. Focus on the simple strategies that will give you the edge.